All right, welcome back, guys. Let's get right into it. No time to waste. We're going to look at the stock market technical charts, try to figure out where things are heading in the future so we can find opportunity to make some profit. All right. So, everyone, today is Fed Day. We've got the Fed coming out here in about an hour with their interest rate hike. It's pretty much priced in that they're going to do a 0.5 point interest rate hike, and that is, that's the market consensus. So again, that's what I think they're going to do. If they do a 75 basis point hike, which is a very low probability, but if for some reason they decide to do it, then look for markets to basically tank. I don't see any reason why the markets would not tank on that news. Again, that is not priced in, so the market would need to price that in to the downside. If they do a 25 basis point hike, then the market should rally pretty strong because that's ultimately not priced in either, and that's showing the market that the Fed is actually concerned about a recession, and they are starting to pivot and pivot slowly, but still starting to do less. They're less hawkish than expected. So that would be the outliers, either a higher, anything over, other than 50% basis point hike would be an outlier. So that's how I'd be reading it. Let's look at the charts and see what they're saying and see where if we can infer maybe where the markets are heading in the next couple, in the days to weeks ahead. Okay, triple Qs. Daily chart, we've got, there is some negative divergence, just barely there on the daily chart. It's not fully confirmed or anything, but you can see if I roll out, the high that we opened at yesterday was a divergent high. So if I roll down, you can see that. And if I look at the hourly, it doesn't quite, it is there. It's just barely there. But here's what it looks like in the hourly. Right there, kind of an equal, if I can grab the right chart, equal high there on the spike up on the open yesterday. It was a divergent high. It's not enough information for me to say that we've got a strong negative divergence. And so in general, I don't see negative divergence that is anything that I would want to trade off of as of yet on the daily or the hourly chart in triple Qs. So what does that tell me? Well, that tells me, it tells me that it's possible that we're not going to just sell down after the Fed. Maybe the market wants to spike up and make a new high, a new divergent high. So we'll look for that. And that's really it. Now, the other thing on the daily, we have this downtrend line. This is a very obvious trend line, guys. We're kind of just walking down it. And it's kind of a dual trend line because you have to mark out several data points. But you can see here, this is the all-time high in triple Qs. Both of those start at the same time. Here we hit this lower trend line. Here we hit the upper trend line. And here we're kind of in between. So we'll just consider it a zone of resistance anywhere from, and as I zoom in, the blue trend line that I have, the blue downward trend line is the lower end. And that's sitting at about 293. And then the upper end is sitting at about 301, 300. The 200-day moving average, simple moving average, is at 303. So anywhere up there is the zone of resistance. So if we're going to spike up, and honestly, guys, I can't tell where we're going to go on the Fed. I don't have a good read on it where we're going to go on the Fed. But if we spike up, that would be the zone of resistance where we're likely going to get rejected. Somewhere anywhere from 300 up to the 200-day moving average should be an area where it's objective to short at for sure, and we might actually get rejected. If I look at the pre-market on triple Qs, I have to go down to the hourly to do that, and I go into the extended hours and look at the pre-market. That's exactly where we hit yesterday. You can see there at 379. We basically were trading up at that major area of resistance yesterday and got rejected. So that rejection, that move tells me that, okay, that was the high and we're now going to, start to roll lower, okay? But I don't see divergence helping confirm that, so that gives me pause on taking any kind of major position into the Fed. I am going to likely enter the Fed meeting with a small short position in triple Qs, kind of a mild position with room to add. So let me go through my trading plan. what I'm looking to do is, if we spike up, because there's obviously the potential to spike back up into this 3.0, back into the zone of resistance way up here. If we do that, I'll look to probably add a little bit more to a short position. All right, and then that'll be it. I'll have kind of an entry position into the Fed. I'll add to it on a spike up, and then from there, not looking to really add any more. I'll just wait to add additional amounts to my short position as we start to break down and break levels of support. All right, so that is what I'm looking to do. That's kind of my trading plan for right now. Let's look at the NASDAQ futures, see if they give us any more information. There's the futures rolling out. This is the daily chart. Again, there's your downward trend. So this is the bear market. We're not out of the bear market. Nothing's been broken. The trend's still intact. And yesterday, we hit that resistance level and got a clean rejection. So again, we've got several reactions. 1, 2, 3, and there's a fourth. 4 reactions at trendline resistance, and the trend is intact. So we want to continue to sell the rip into resistance. So what does that mean? Again, if right after the Fed, if it wants to spike into resistance, that's an objective area to short. If it spikes up to the 200, maybe it runs up and tags the 200 right now. That's about 12,466.75. That would be objective, because I would expect a spike into the 200 to get faded and start to break down. So any kind of spikes into that area are objective to short at. And until those areas are taken out, then those are going to be resistance, and we look to short into resistance in a bear market, in a downtrend. So that is what I have there. Looking at the hourly chart on NASDAQ futures, again, no real negative divergence here on the hourly that I can tell of. The spike up yesterday made a new high, so we don't have negative divergence to help confirm. So again, that kind of keeps me guessing. It doesn't really, it's not the cleanest trade setup, and that's why I'm not looking to go any heavy position into the Fed. If they spike it up and make a new high over yesterday's high, and it puts in a negative divergence, that's probably going to help firm up the fact that we're rallying into resistance and it's going to get rejected. Okay, so maybe it spikes up, makes a slightly new higher high right after the Fed. The RSI and the PPO can't make a new high, and we start to put in that negative divergence, and likely that's going to help shape up that we are hitting key resistance and going to reject from there. So that's how I'm looking to trade the triple Qs, guys. Okay, flipping over to the S&P 500, the SPY. No real change here. It's pretty much consistent with the Qs. Looking at the daily chart, you've got resistance. There's a downtrend. So resistance, resistance, resistance. Hit it again there. And yesterday, that spike up was resistance, was rejected. So we have not changed trend. The trend is down, and that's it. Keep it simple. The trend is down. Until it shows us something different, we go with the major trend. We rallied into resistance, got rejected yesterday pretty impulsively. But I figured yesterday, and if you're in the private member group, you know that I was posting in there. I talked about how we came down to gap fill. Let me look at the hourly here. I'll show you guys. We sold off yesterday, gap filling right there basically. And there's that gap. We filled it, and I said that's probably the end of the selling, guys, ahead of the Fed. The market's not going to just dump right ahead of the Fed meeting. And so that was kind of a gift from a short trade. Took that at the open on triple Qs, shorted at the open, and I covered my short at the gap fill because, again, I don't want to be into any one heavy position right ahead of the Fed. So there's the gap fill right there. Looking at the hourly chart, you can see we basically spiked up, you shorted it down to the gap fill here, and that was all. That was all the selling for the day, and sure enough, that's how that played out. So, all right, so that is that. The SPY has no change. We are in a downtrend, and at the end of the day, we're at a point. Let me go to the daily here. We're at the point now where, as I roll out this downtrend line, we're at kind of key areas of resistance, just below it, but basically there. If the Fed wants to pivot, if they're scared of the market going into a complete recession and the market, really getting pretty bad, I guess, then they'll probably need to do that here and now and signal to the market that they're done hiking and they might even start easing. So if they don't do that, if they don't give that signal and they come out hawkish again, you're probably going to see the next leg down in the bear market. And probably, at this point in time, we're probably going to get to the point where we're going to see pretty impulsive selling to maybe flush out this bear market before a sustainable bull market or a sustainable bear market rally. These rallies in this bear market, they're quick. They're impulsive and they're straight up, but they're fast in time, and that's a signal of a bear market. The bear market, you have more sustainable moves down and these quick little spike rallies higher as shorts are covering and some hopeful longs are piling in, dip buyers, things like that. But you're not going to get a sustainable bear market rally until we have some sort of capitulation selling, and I just don't think we've had that yet. Okay, so in the past, pretty much all year, we've seen a rising dollar, which has been bearish for the market, and it's been a safety play. The dollar, and my chart's a mess, but as the dollar's been rising, the market has been falling. And recently, you can see we've got the dollar has been falling. It's broken this uptrend, and we've been falling. So, are we going to see a rising dollar? Are we at that pivot point now where the dollar is likely going to rally again and see, and that would be bearish for the market. So as you see here in the dollar, this is the dollar futures. We're sitting at a level of support. It's about 103.65. That is outlined here. You can see some reactions right in here, and it's a level of support. Now, there also is another level down below. If I roll out, and I really have to go almost to the weekly to show this level, but this is the key level. Look at this. It starts all the way back in 2011. All right, support. This is a weekly chart, so big trends here. Big cluster of support right through here, and then a little reaction right there. But in general, a lot of tags of support. Does the dollar want to sell down to that? If it does, that is a key level of support, and that's about 101.84. So that is possible. Maybe the dollar has a little more downside, maybe not. Let's look at the daily and see if there's anything we can kind of pull from the chart. Looking at the RSI and the PPO, slight divergence. I can see it just starting to show up. It's going to show clear on the hourly chart right here, guys. So you'll see here, okay, you see that momentum starting to kind of tick up on the hourly while price continues to kind of dip low. So that's a divergent low. If we want to spike down, which is completely possible, we might spike down right after the Fed. That would be a divergent low. I'd look for that spike down to probably get bought up, given the divergence. All right, so what I would do is just probably wait, see a spike down, wait for the recovery back above this 103.61, and that will likely signal that spike down was a false breakdown / divergent low, and the dollar's about to start to rally. Okay, and if you see that, you're likely going to see the market start to sell off. You'll probably see gold sell off as well. So let's look at gold here. Okay, here's gold bullion. No real divergence here on the hourly. At least nothing that I can really pick up on. On the daily, slight divergence there on the daily. Just starting to show up. Not fully confirmed, but this high that is being made is a divergent high. Okay. So I'm not sold on gold rallying right here. Again, the Fed is going to move these markets. So it's really hard to tell what's going to happen today. And as such, the way that I like to mitigate risk in that is to taper down my position sizes. So I don't have a large position in gold miners right now. We caught a lot of this rally, but I need to see how the market's going to trade out today before I can start to get a better read on it and take a position. So no large position there. I am going to go into the Fed mildly short, nothing crazy. So if it moves against me, it's not going to damage me. And in fact, I'll look to probably add to a short position. And that's as long as the technicals continue to look like we're in that downtrend. We start to break the downtrend in the markets, and I have to change my tune. So I don't know what's going to happen. Maybe that does happen. So we'll just evaluate. But as of now, I'm going to go with the trend. And the trend so far this year is a bear market. And we're basically right at resistance with the potential to kind of spike up, do a little spike into the Fed, which should provide a really objective shorting opportunity, which I'll be looking to take. FSLR. This one's been a short trade for a while. It still looks good. I'm going to stay short on this one. Again, daily chart, bullish falling wedge pattern, big negative divergence on the daily. This has been building for a while now. So huge negative divergence on the daily. It's on the weekly as well. We broke trend, okay? And last 3 days, we've been back testing. Now this makes sense. You back test, and this is a back test, a move up higher on weakness. One thing is it's rallying right ahead of the CPI and the Fed. Okay, that's not a move that there's probably retail traders. That's not really a strong move that big institutions are going to be taking a position right ahead of big market moving events like that. So this is likely retail traders just buying this thing, and we're rallying into resistance. So we can spike higher. After the Fed, we might spike up to this, 167-ish. For me, that's an objective area to short. All right. So if you're so inclined, you could obviously add to a short or initiate a short on a spike up into this trendline resistance. Otherwise, I see this selling down. So whether you spike into resistance, then roll down, I'm still looking for over the next weeks, days, months, rally up and then reject and continue to work our way lower. All right. So this should trend lower, and that's all I have on it. QCOM's kind of interesting to me as a short, but here's what I've got on it. So on QCOM daily chart here, you can see we do have some negative divergence just starting to show up here on the daily PPO, and it's there on the RSI. Or sorry, there's the PPO. On the RSI, it's there. We're kind of chopping around. We've been consolidating around this key level, which is really about 123. As I roll out, you can see reaction. There's a resistance, support, 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 and kind of a cluster right there. So big reaction level and even reaction there. And we've been consolidating around that level. So the market's at, this is at a decision time. We have some negative divergence just showing up. We also have this downtrend off the highs to watch. So you can see resistance, resistance, resistance. So at the end of the day, after the Fed comes out, if this wants to spike up, it could do that. If it spikes up, that's a key objective area to short at, right? In anywhere from 130.50 up to the 200, which is about 134, not really above. And then I would look for that to get rejected. If it doesn't get rejected and we continue to build, we would look to stop out. That's it. Nothing says I'm going to be right on a short entry. All right, so that's what I have on that. If it wants to spike up there, that's objective to short. And then otherwise, it should start to continue to sell down. And on the daily, we've got this gap to fill all the way down here at 93.85, 94-ish. I've got it ticked out. I've shown you guys this a lot. Just want to reiterate it. But there is key level of resistance right in here. Lots of reactions right in that level. Okay, and there's a gap, big old gap from back in July of 2020, it looks like, or August, somewhere right in there to fill. So I think that's where we're heading, honestly, whether we spike up into resistance or not. I think it's limited upside, and we're about to make the next leg lower to run down and fill that gap. And then also, there's potential uptrend line support. It's not confirmed, but you can see 1, 2 reactions, and that falls in line right about there as well. So if you fall down there, you're going to have, I think, a decent enough case to say that that's pretty strong support. If you were going to short, that's an area I would be looking to cover slightly above 94 area. All right, so there's the trade idea. Again, I don't know how it's going to work out today, so I'm not looking to probably take a position into the Fed on this one. But if it does spike up, I would look to take a position in that spike up. So name of the game, guys, pretty much before I wrap up, is I'm looking to sell the rip. All right, I'm looking to short rallies into resistance. As long as that resistance holds and everything kind of holds up and looks okay, then we'll get positioned on short trades at key levels of resistance which is the lowest risk area we can do. And then we manage the trade. Guys, if you're interested in learning this as a skill set, check out my stock market technical analysis course. Link in the description below. It's 4 to 5 videos, broke it out into different concepts. Also, I give you guys a checklist of what to look for finding high probability trade setups and making sure you're managing your risk properly. Okay, link in the description on that one. Again, the private member group, I'm in there pretty much every day, giving you guys additional insights, additional trade ideas. Haven't been in there today because it's Fed day and I don't want, pretty much everything I have to say I'm putting out in this video for today. So that's it on that one. But if you're interested in that, link in the description below. It's $5 a month. So at the end of the day, you're talking less than a cup of coffee nowadays with how much Starbucks costs, per month. So no big deal there. And, if I can put you on a couple winners, it easily should pay for itself and a lot more. So link on that one. Drop me a thumbs up. I appreciate the comments. Even the critical comments, I appreciate it. As long as you're using data and facts to criticize my calls, that's fine. If you're just attacking me for the fun of it, that's just trolling. Whatever. We'll never get rid of those guys. But all right, guys, I'm going to leave it there, and we'll pick up where we left off either tomorrow. If anything gets crazy, maybe after the Fed. But yeah, best of luck, guys.